here are some other benefits that employees of a company may receive. Two big ones are employee bonuses and vacation benefits. So for an employee bonus, it is a set amount of money besides the regular paycheck or salary of that individual that they receive for one reason or another. The most common one that people think of is the Christmas bonus, which is a flat amount. So at the end of the year, the company will say we're going to give all of our employees a $400 Christmas bonus, flat amount to each employee. Other employees of that company, though, depending on their stature, may also receive a bonus based on the profitability of the company. At the end of the period, whatever amount of income the company has made, the officers of that company are probably entitled to a percentage of that. So they figure out what the company's income was during the period and distribute a set percentage of that, 1%, 5%, whatever, to certain employees. Vacation benefits, we all like paid time off. Can be awarded in either a fixed amount per year, you get 1 week of vacation per year, or based upon the amount of time that you've worked there, you accumulate your vacation. So 1.5 days of paid vacation for each month worked. Percentage-based bonus plans can be tricky, and the reason that can be tricky is that first line, that the percentage is based on the remaining net income after the bonus is paid. What do I mean by that? Well, let's take an example. Let's say that Woodrow Wire Company here had $315,000 worth of net income during the year 20XX, and they're going to distribute 5% of the net income as a bonus to its executives. Everybody's first instinct is, all right, 5% of net income, so you just multiply the net income by the percentage, and you would come up with $15,750 in employee bonuses. Well, there's a problem with that. Why? Because if they had $315,000 to start with and they paid out $15,750 to their employees as bonuses, the company would have $299,250 of remaining net income. What percentage of the remaining net income is that? It's 5.26%, but employee bonuses are based on net income after the bonus is paid. So here we're basing it before, not after. This isn't 5% of after bonus income, it's 5.26%. So we can't use that method. To do this correctly, you have to use the following formula, which is the net income before the bonus times the bonus percentage divided by 1 plus the bonus percentage. So in this case, Woodrow Wire, with their $315,000 in net income, is going to multiply that by the bonus percentage of 5%. And they're going to divide that product by 1.05, 1 plus the bonus percentage, and they're going to come up with $15,000 in employee bonuses. Well, if they had $315,000 in net income and they're giving $15,000 to the employees, that means there's $300,000 in remaining net income for the company. And $15,000, the bonus, divided by $300,000, the remaining net income, is indeed 5%. So the employee bonus is now equal to 5% of net income. So when you declare an employee bonus, you have to use this formula because that bonus is the amount of money you're paying out based on the net income after the bonus is distributed. So now we've figured out that the employee bonus is $15,000. How do we book it? Well, what accounts are going to be affected? The two I am choosing to use are employee bonus expense and employee bonus payable. I have seen before where they use one account for all the different types of benefits, just called employee benefit expense and employee benefit payable, respectively. I like to separate them into things that are more specific. So I would have an employee bonus expense. I would have a vacation benefits expense. You don't have to. I just think it's the best methodology to go about. So we're going to use these two accounts. Employee bonus expense is obviously an expense, and payable means liability. The amount of expense that we're recording for paying out our employee bonuses is going up, as is our liability for this bonus. So employee bonus expense is going to be our debit, and employee bonus payable is going to be our credit, and the entry is going to look just like this. In this entry, we declared an employee bonus to executives. So again, you have to make sure that the bonus is based on the remaining income after it has been distributed by using that formula on the previous slide. Next up, we have the journal entry for the accrual of vacation benefits, matching principle. Whenever you have an expense, it has to be recorded in the same period that it helps you earn revenues. Well, these employees worked during the year 20XX. So even if they're not going to use this vacation time until the future, you have to record it in the year that they actually earned it. again, we're going to separate our accounts. So it's going to be vacation benefits expense and vacation benefits payable. What type of accounts are these? Vacation benefits expense is an expense. Payable means liability. The expense is going up, the liability is going up, therefore vacation benefits expense has to be our debit, while vacation benefits payable is our credit. In this journal entry, which we're going to record on December 31st, we're going to start by debiting vacation benefits expense, but for how much? Well, you have to figure out how much they were making at the time to come up with the liability you owe. So Woodrow Wire has 50 employees. They earn $500 a week, and each employee is getting 2 weeks of paid vacation. Well, $500 a week and 2 weeks of paid vacation means that they owe $1,000 in vacation pay to each employee, and they have 50 employees. So if we multiply that all together, 50 times 500 times 2, it's $50,000 in vacation benefits that they are eligible to pay to their employees. If the employees leave, they probably have to pay them their back vacation time. So that's the amount of liability and expense that we are going to put on the books when we record our vacation pay liability. Here's the journal entry for the payment of vacation benefits. So we put the liability on our books. We accrued it to make sure that those, benefits expense was recorded in the period that our employees actually earned it. Now we're going to pay them. Well, what accounts are going to be affected? The first one is going to be vacation benefits expense. Why? Well, if you read in our description, our employees used 4 weeks of paid vacation. However, the big catch is that they got a $25 per week raise. They're now making $525. When we put this liability on the books, we assumed they were going to make $500 a week. And now that we've given them a raise, we don't have enough expense on the books. Why? Because whenever you pay vacation benefits, you always pay your employees at their current wage scale. Somebody would be really mad if they earned paid time off 10 years in the past, had it sitting there, and finally decided to use it 10 years later, and the company was like, okay, well, you earned it 10 years ago, so we're going to give it to you at your pay scale 10 years ago when we put it on the books. It doesn't work that way. You have to pay people their vacation time at their current wage scale, and since this has increased from the time that we accrued it, we need to put more expense on the books. We're not going to owe these benefits anymore after we've paid them, so the liability has to come off the books, and we're obviously handing over cash to our employees. What type of accounts? Well, vacation benefits expense is an expense, vacation benefits payable is a liability, and cash is an asset. Are they increasing or decreasing? Like I said, we need to put more expense on the books, so vacation benefits expense is going to go up. Vacation benefits payable is coming off the books because we no longer owe it to our employees, so it's got to go down, and the cash is coming out of our company account and going into the hands of our employees, which means our cash also has to be decreasing. Therefore, we're going to debit vacation benefits expense. We're going to debit vacation benefits payable because all liabilities go down on the debit side, and cash, as we know by now, goes down on the credit side. So when we start this entry for the payment of vacation benefits during January, we're going to start with a debit to vacation benefits expense. But for how much? Well, we already put the majority of this on the books. We put vacation benefits expense on the books, assuming our employees are going to be making $500 a week. They're making $525. So what we need to do is we need to increase this by the amount that they've increased. They increased by $25. $525 minus $500 is $25 difference, and they're using 4 weeks of vacation, which means we're going to throw this on the books at $100. That's what we need to increase this by. The payable that we put on the books was at $500 per week, and this is 4 weeks, which means $2,000 has to come out of our payable. We're taking off at the rate that we accrued it before in the last entry. And lastly, cash, how much are we going to hand over? We have to pay at the current wage scale that they're making. They're making $525 a week now, and for 4 weeks it's going to be $2,100. Again, is their current pay scale times the amount of weeks being used. And this is the journal entry to record the payment of vacation benefits.